Hey guys, it's Chad Larson with MLB Wealth. It's April, a couple days late, just timing of trust filing deadlines and quarterly reporting. It's taken me a couple days just to kind of wrap myself into a window of time. But getting into it, listen, last month we had a guest speaker on, Travis Dowell from Maxim Capital. I hope you guys enjoyed that. I did a brief little send out in the advent of a significant market event. And sort of up on the podcast, you'll see some of my commentary in and around Silicon Valley Bank. And that's really continued to dominate largely a lot of the news flow of late with respect to market conditions. I want to spend just a quick minute, and I'll do my best to not belabor. I don't want to sit here and for months and talk about Silicon Valley Bank, because not that it's not an issue, but what are the other things driving the market? And I want to talk about, listen, this is a bank bust, and we've been consistently warning that developed markets are in the early stages of a policy-induced downturn with a historic rise in interest rates. It's like tightening a wrench. It's going to squeeze things tight, and you have the unforetold risk of breaking things when you tighten them too much. So far, hard data only points to slowing demand in interest rate sensitive sectors like residential investment or durables manufacturing. In contrast, we're still seeing strong spending on service, and that's continued to support job creation. So a lot of the job numbers we haven't seen them turn down like you would want to see them during an interest rate hiking cycle to tame inflation. But the recent failure of European banking giant Credit Suisse and obviously the two mid-sized U.S. banks, Silicon Valley and Signature, suggest monetary tightening could result in a deep recession. If you go back a couple podcasts, we've been talking about this recession like the most anticipated thing in history. But the key risk in this respect is an economy-wide liquidity crunch, whereby elevated risk aversion triggers a drain on bank deposits and a tightening of lending standards. That's all a bad thing, but a good thing. Like these are tough medicines to fix the economy. So liquidity risk has caused financial stress to surge in the past week. Talking about how that affects positioning strategies, how that affects the commodity complex, the currency markets. I'll touch on a brief few things, but with respect to GDP growth in this context, I think economists, investors are remaining a little overly optimistic around developed markets growth. Professional forecasters currently anticipate GDP growth of 0.8% this year, which is about a 60 basis point upward revision from their 2022 projections. While this remains below potential growth, range bound in around 2%, market expectations, I think, are seriously downplaying the drag of rate hikes of the real economy. And one of the things I've been trying to do at a personal level is try to anchor myself around having like a quote of the month or a phrase that I whether for amusement, pleasure, or for being pragmatic about implementing a new process into how I think or how I behave, whatever it might be. But all of last month, many of you heard me say two things can be true at the same time. But listen, it typically takes over a year for higher borrowing costs to have a material impact on demand. Fed hikes have lowered industrial production by 2.5%, but should have twice the impact by 2024. Yet rate hikes can cause faster and deeper output losses if they endanger bank balance sheets. But normally in this situation, central banks react to tight financial conditions with aggressive rate cuts. Indeed, following Silicon Valley Bank's collapse, bond markets have lowered their expectations around Fed rates by about 150 basis points, pricing in 3 to 4 cuts in the second half of 23. I think people like myself, economists, pundits on TV, we sit there and try to, impress our clients and our listeners by, making bold calls. I think we have to strip it back sometimes, and we have to impress upon our clients and investors, some of the basic principles in and around, what it is you're here to do. We're here to position and allocate capital across a spectrum of investment opportunities such that we seek to earn our share of market returns and try to turn down the market volatility and the risks that we're taking. So, the kind of the push and pull in and around market rates are market rates by an index. The volatility of indexes, largely from a cash flow smoothing standpoint, cadence to which investors need cash flow from their investments, doesn't work out. So academics say by the market, but in reality, drawing down on your capital during periods of capital compression, exasperate and over accelerate the depletion of funds. So it's a very complicated way of saying, like, it's very easy from a book, but it's also gets easier the further you step back. So kind of back into it, like the market view, I think ignore the market's ignoring the fact that developed markets still are facing elevated inflation risk. So as long as tight labor supply keeps wage growth high, an aggressive easing cycle, meaning cutting rates, is unlikely, kind of worsening the medium term growth prospects. Back to what I said about two things can be true at the same time, kind of refers to something when we go back to our original outlook, is that we thought the market would be, very choppy for the front half of the year. You're still a little bit of ways from June, but it's creeping up, very quickly. But the original outlook was markets are going to be choppy for the front half of the year and into the back half of this year. We felt the markets would be constructive. Again, another word for good. But I think the markets will be constructive into the end of the year as they look to discount, the eventual recovery we see in 2024. So that's going to be one of these things. And what is kind of odd is to say, I think we're going to have a bad economy and a good market. The same way we've had good markets and bad economies, which would be the perfect example to talk about COVID. We had great markets and terrible economies. Basically, the world was shut down. So two things can be true at the same time, and things don't have to always make sense. So because the market is a forward-looking vehicle, we remain nimble and being ready to react to that. So one of the other things too is people think of recession as a four-letter word, and I've talked at length about portfolios are not light switches; they're like taps. We tighten them and we open them up based on our sentiment around risk or opportunity set, given price action, outlook, results, etc. But within inflation, it doesn't mean profit is all going to go away. So as well as consumer prices coming down, that top line, we see that the outlook for inflation is consumer prices are decelerating. Falling energy prices and an easing of supply chain disruption have eased headline inflation in most major economies. Weak goods demand should translate into much lower inflation in 2022. But there's still very high probability inflation continues to exceed central bank targets. And this primarily reflects tight labor supply and elevated inflation expectations. So again, more job loss to come. But while prices are coming down, that doesn't necessarily mean there's a fixed cost of production, because producer prices are declining as well. Lower global manufacturing demand, a sharp reduction in shipping costs, falling oil and natural gas prices should result in much lower PPI inflation. That's a producer price inflation than in 2022, which was up 17%. The most likely outcome is global PPI inflation to average 2.4 in the full year of 2023, slightly below the average of 2.7. So top line coming down, but cost to produce goods, coming down at the same time. A lot of question in and around currency right now, there's been some, call it, obviously a complete lack of media attention to it, but some jockeyings globally in and around some cracks in the veneer with respect to ongoing tensions between Saudi Arabia and the U.S. and kind of a distancing themselves and maybe other major global economies from the U.S. dollar. But with respect to most of our investors being Canadian, I think our outlook on Canadian dollar is neutral. So the loony weekend in March, as falling oil prices worsened Canada in terms of trade. Oil should fall further in the near term. I've said short-term bearish and long-term very bullish. So again, two things can be true, or you can be the same thing at the same time. So from an outlook of a recessionary trade that gets put on when you expect global growth to be muted, things like energy and materials and stuff have their kind of pause for call, because it's a very quick recessionary trade, is because they require their GDP participants. When GDP is growing, you use more energy, you use more coal, you use more steel, you use more oil, timbers, all of these things. So in the short term, as people are fearing of a deep recession, this recession is going to be consumer spending led, not necessarily so much on manufacturing spend. So As that oil falls in the near term, it's going to exert some downward pressure on CAD, on the Canadian dollar over the next 3 to 6 months. And this outlook improves at longer horizons, given the high probability that Canada outgrows other G7 countries through this year and going forward. It's a lot of, and I hope this kind of made sense and around, what I wanted to kind of get across. And this wasn't going to be a long one, but our game plan kind of remains the same. We're staying lighter in exposure and slightly defensive in sector allocation, and we stand ready to take advantage of any weakness if and when bad news becomes bad news. I was explaining to a great friend of mine yesterday at lunch. At any given time, two things can happen: bull, bear, up, down, left, right, all of these things. And in any given day or in any given quarter, year, economic cycle, you're weighing the weighted probabilities of those events happening. And I would tell you that from price action and sentiment, there's a lot to be negative about right now. But what I kind of put on the other side of that is there's still a historical amount of liquidity on the sidelines. The worst of it, we feel, is far behind us. So I think we're in the bottom part of this W, and this kind of reminds me of, I guess, a horrible time. But I remember talking a lot on Zoom and through sendouts during COVID with clients as everyone was debating whether this was going to be a U or a sharp V recovery. And so apparently we're using letters to give people visual representations of what we're seeing. We're definitely in the W right now. We're at the bottom of it, bouncing along. There's absolutely boogeymen. There's absolutely potentials for turbulence or pockets of air that could see us drop. Yeah, we could retest the lows, but we're so far off from the highs and the global indices. We remain, well positioned in high quality businesses and looking. I cannot tell you how excited I am and the amount of high quality deal flow that we're seeing, and more on the alpha drive side of our business, of high quality companies that you know not only don't have access to capital, not from a save themselves standpoint, but also see the opportunity of being constructive. The phrase remains: you make all of your money in a bear market, you just don't know it at the time. And so we stay with liquidity, we stay ready, vigilant, to both protect portfolios, but also to take advantage of price action and opportunities we present themselves. As always, feel free to give any one of us a call on the team. Send me an email, messenger pigeon, whatever you have to do. But it's our absolute pleasure to call you private clients. And if you need anything at all, please don't hesitate. Have a wonderful month. Look forward to talking to you all very soon.